Another blow to the Bay Area. Companies leaving town for much cheaper taxes and a cheaper cost of living.
On December 11th, 2020, Oracle changed one line of paperwork and a $200 billion giant was suddenly gone from California. No press conference, no CEO speech, just a routine filing after markets closed that quietly relocated its headquarters to Austin, Texas. And here's the part most people miss. That single sentence didn't just move an address, it exposed how fragile California's corporate grip has become when the biggest companies can vanish on paper overnight. Oracle's move wasn't a one-off headline, it was a signal flare. In the years after the pandemic, San Francisco's office market cratered to a record 37% vacancy in mid-2024, turning once elite towers into financial deadweight, San Francisco standard. At street level, the collapse got so extreme that a downtown office building at 995 Market Street sold for $6.5 million, nearly 90% below its prior sale price of $62 million, San Francisco Chronicle. And at the state level, California's budget whiplash went from a reported $97.5 billion surplus to forecasts of a $68 billion deficit. PPIC California Legislative Analyst's Office. But here's where it gets wild. Oracle didn't just leave once, and the next destination reveals what this story is really about. Oracle's one-sentence exit. Why it was designed to be invisible. Oracle didn't announce its headquarters move like a victory lap. It slipped it into the public record. According to CNBC, Oracle disclosed the change in a filing stating it was implementing a more flexible employee work location policy and moved its corporate headquarters from Redwood City, California to Austin, Texas. CNBC Reuters reported the same shift, a Silicon Valley stalwart moving its corporate headquarters to Austin, joining a broader trend of relocations and expansions out of California. Reuters. Now here's the key detail. A headquarters move can be partly symbolic, an address change, a legal and executive center of gravity shift, while major operations remain distributed. That nuance matters because it changes how we interpret companies leaving California. Sometimes it's jobs and facilities. Sometimes it's the tax address and the message. Sometimes it's leverage, telegraphing that the company can move, even if it doesn't move everyone. And that leverage is powerful in the post-2020 economy. Once remote and hybrid work went mainstream, being in Silicon Valley stopped being a requirement and became a cost-benefit decision. The moment location becomes optional, high-cost states lose one of their strongest bargaining chips. Wallet impact makes this real. When a corporate center shifts, it can influence where executives live, where top earners pay taxes, where future growth is staffed, and where real estate is leased. That doesn't just hit a skyline. It hits city budgets, transit funding, and local business revenue. Because fewer daily commuters means fewer customers, fewer leases, and less tax stability. But that's only part of the story, because Oracle's next move suggests it wasn't simply fleeing California. It was chasing something much more specific. CNBC. Oracle HQ move disclosed. Remote flexibility framing Reuters. Oracle corporate HQ moved to Austin. Contextual explanation built from the above reporting. Nashville wasn't about politics. It was about a new industry. In 2024, Oracle's headquarters story took another turn when Larry Ellison said the company's planned Nashville campus would become its world headquarters, according to KSAT reporting. KSAT. That sounds like another political red state versus blue state headline, until the numbers reveal the strategy. Oracle tied itself to healthcare in a way it never had before, especially after its $28 billion acquisition of Cerner, a major health IT company. Once Oracle went big on healthcare data, the map changed, and Nashville isn't random. The city markets itself as a healthcare management and hospital services hub with deep industry concentration, meaning the talent pool, partners, and customers are already there. Then comes the incentive architecture. Tennessee approved $65 million in state incentives connected to Oracle's plan to bring 8,500 jobs and a $1.2 billion investment over time. AP News. This is the part viewers should pause on. States don't just win companies anymore, they bid for them. And incentive deals are structured like contracts, job targets, investment milestones, and political pressure on both sides. For workers, the impact is uneven. High-paying jobs are promised, often with average salary figures cited in local reporting, while existing employees may never relocate. But for the region receiving the investment, it's a scoreboard moment. New payroll, new construction, new tax base, and a long-term brand upgrade. Now here's where things get interesting. Oracle's moves show the same underlying force reshaping California's business landscape. Location became flexible, and once it did, the office economy started collapsing in places built around daily white-collar density. KSAT, Ellison says Nashville campus will be World HQ AP News. $65 million incentives, 8,500 jobs, 1.2B investment, healthcare cluster logic derived from the above context, and Cerner deal reference in coverage. The San Francisco office collapse, the second domino. Remember the open loop? Oracle's HQ move seemed symbolic. The real damage shows up in real estate. In mid-2024, San Francisco's office vacancy hit 37%, a level that would have sounded impossible before 2020. San Francisco standard. And the collapse isn't abstract, it's measurable in sales. The San Francisco Chronicle reported that 995 Market Street, an empty 16-story office building, sold for $6.5 million, down from a previous $62 million sale price, nearly a 90% plunge. San Francisco Chronicle. That's not just a bad deal for one investor, it's a warning sign for the entire city's tax base. Commercial buildings feed property tax rolls. When valuations crater, revenue pressure grows. And when cities are squeezed, public services become harder to fund, exactly when businesses and residents demand more safety, cleaner streets, and better transit. Here's the loop this resolves. Oracle didn't have to physically move tens of thousands of people to hurt California's economic model. It only had to validate a new reality. Companies can spread out, executives can live anywhere, and office demand can evaporate. Once that happens, every additional HQ shift becomes a headline that accelerates market psychology. Tenants hesitate, lenders tighten, and more space goes dark. Now the new open loop. If California is losing, why does it still dominate the corporate leaderboard and venture capital? That contradiction is where the real investigation begins. San Francisco standard, 37% vacancy, mid-2025, San Francisco Chronicle, 995 Market Street sale at 6.5 versus 62 millats. Municipal tax base linkage. Standard fiscal mechanism explained using above market facts. California's revenue problem. When the top moves, the floor drops. California's budget story is a volatility story. In 2022, the Public Policy Institute of California discussed the state's reported $97.5 billion budget surplus. Say on PEIC. Then, by late 2023 into 2024 planning, the non-partisan California Legislative Analyst's Office estimated the state faced a budget problem on the scale of $68 billion. California Legislative Analyst's Office. That swing matters because it reveals how dependent the system is on high earners and capital gains. Revenue streams that can surge during bull markets and collapse when markets cool, IPOs slow, or top taxpayers relocate. This is where migration data enters the story. The IRS publishes state-to-state migration statistics, tracking flows, and adjusted gross income tied to movers. IRS and California's own legislative analysis has discussed increased outflow in pandemic-era migration patterns. Laws. For regular people, the wallet impact is indirect but real. When revenue projections fail, governments cut programs, delay infrastructure, and fight over budgets. When cities lose office value and states face revenue shocks, the burden shows up as service reductions, pressure for new taxes or fees, and a slower recovery cycle. But here's the contradiction. California still isn't empty. In fact, by Fortune's own reporting, California remained the top state for Fortune 500 headquarters count in 2024. Fortune? So how can both be true? Companies are leaving and California is still number one. The answer is the difference between legacy scale and future growth, and the next section closes that loop. PPIC 2022 surplus figure context, California, LAO, deficit estimate, IRS, migration data source, LAO, econ tax, migration outflow discussion fortune, California Fortune 500 houses, HQ count led, the paradox, why California can win and still bleed. California can lead the nation in corporate prestige and still suffer structural erosion underneath. Fortune reported that California topped other states in Fortune 500 company count in 2024. Fortune. But a headquarters count is a snapshot of where large legacy companies are based, not necessarily where the next decade of expansion will happen, where new campuses will be built, or where executives decide to plant a long-term center. That's why Oracle matters, not because it instantly removed thousands of jobs, but because it proved the move can happen quietly, quickly, and repeatedly. CNBC. Now zoom out. Tesla's own SEC filing stated it relocated its corporate headquarters to Gigafactory Texas in Austin, effective December 1, 2021. SEC Toyota also represents the earlier version of this trend. It officially opened its new North American headquarters in Plano, Texas in 2017, after announcing the consolidation years earlier. Toyota Press Room. These moves aren't identical, but together they reveal the competitive battlefield. States aren't just competing on taxes. They're competing on cost of living, housing availability, regulatory speed, incentive packages, and whether a company believes it can recruit talent without forcing everyone to live near the bay. And here's the punchline. Once remote work broke the geographic monopoly, California's greatest advantage, dense clustering, began to weaken in the exact places built to monetize it, downtown office corridors, which takes us back to the 37% vacancy problem. Because even if California remains an innovation engine, empty offices and shrinking tax bases can still trigger civic decline that pushes the next company to quietly file its way out. San Francisco standard. The final question isn't whether California collapses, it's whether it adapts faster than the next round of exits. Fortune. CA leads. Fortune 500 HQ counts CNBC. Oracle HQ moved to Austin SEC. Tesla. HQ relocation filing, Toyota Press Room, Plano HQ opening as San Francisco standard. Office vacancy context. So here's what we know. Oracle changed its headquarters in a quiet filing on December 11, 2020, and pause, signaling that even the most established Silicon Valley giants can relocate with minimal friction. CNBC. At the same time, San Francisco's office crisis hit a record 37% vacancy, and the financial damage became visible in sales like 995 Market Street collapsing to $6.5 million. San Francisco Standard, San Francisco Chronicle. And statewide, California's fiscal outlook swung from a reported $97.5 billion surplus to deficit estimates around $68 billion, exposing just how volatile the revenue model can be when markets cool and top incomes shift. PPIC California Legislative Analyst's Office. What happens next is measurable. If vacancy stays elevated and valuations remain depressed, city budgets face prolonged strain. If taxpayer migration continues, revenue volatility remains a permanent stress test. And if incentive-driven campus wars expand, more companies will test how little they can move physically while still moving the center of gravity. IRS Oracle's exit wasn't just a move, it was a blueprint. The data doesn't lie.